Today we have invited Sonali Rodrigo from Tomorrow Financial Solutions to discuss about income protection. Hi Sonali, welcome to our show.
Thank you, Nishani.
First of all, would you like to tell our viewers about what income protection is?
Yes, Nishani. So, income protection, as the name suggests, is basically an insurance that you take to protect your income. So, your ability to earn income is probably one of your biggest assets. So, over the course of your working life, if you look at and quantify your salary, it's going to run into the millions pretty much for a lot of people, because if you start working at 20 and work till about 65, that's 45 years worth of income that we are talking about. So if you lose that income, your ability to do things, to live your life pretty much within those years is going to get affected, and your lifestyle would get affected drastically. So let's think about if you have a mortgage, if you have bills to pay, if you have children who are schooling, all of that gets supported by your income. So if you lose that, then all of those things get affected as well. So this particular insurance will cover your income, typically 75% of your income, in case there's something that happens to you and you're unable to work and earn an income, it will pay that. So it's like getting an income until you're 65, but the insurance company will pay that.
All right. So would you like to share some information in terms of the features of this particular insurance?
Yeah. So a lot of the time I get clients telling me one particular income protection company offers something way cheaper than the other one. So the differences are the fact that there are a lot of features in this type of insurance. So not a lot of people understand. Now, one of the main things is what we call agreed value and indemnity policies. So agreed value policies means you go to the insurance company and say, this is my salary, this is what I'm earning, and here are my pay slips or tax returns or whatever that you give to prove it. And then the company agrees at the time that you're applying for the policy, yes, that's what you're earning, and we will cover you for that. Whereas with indemnity policies, you don't do that at the time of application, you do it at the time of claim. So imagine when you are sick or injured or unable to work, having to run around trying to prove to the insurance company that you are earning a certain amount. The risk with that sort of thing is, say if you took time off work or you were on maternity leave or something, and the couple of years before the event happened, you were not working or your income had gone down, then you run the risk of not having a payment, because the insurance company can say, oh, actually we've looked at your last 2 years and this is your average earnings, so we're not going to cover you for what you thought you were going to be covered, we're just going to cover you for that. So I advise a lot of clients to get agreed value policies for peace of mind, because otherwise at the time when you need it the most, you might find that the insurance company will say, oh, sorry, that's just not going to work. But having said that, there are instances where, say, if you're self-employed, for example, you might not have had stable earnings. The insurance company might not cover you for agreed value. So there are things that impact your ability to get agreed value policies. But and the other thing is obviously premiums are higher with agreed value policies. So that's why a lot of the time people think getting indemnity is better because the premium is lower, but then they don't understand the implications that can have on the actual cover and what they think they're covered for. Another thing people forget is the difference between stepped and level policies. So stepped premiums means that every year as you age, the premiums go up. With level premiums, you have a constant level of premiums, usually just adjusted by inflation. So if you're having the cover for a long period of time, it might be in your best interest to look at level premiums as well, just so you can keep the cover premiums stable over the course of the period that you're having the cover. So those are two things that heavily impact premiums that not a lot of people understand. And there are other things like benefit periods where income protection benefits can be covered for 2 years or 5 years or until you're 65. So sometimes I ask people, okay, if you get a claim paid for 2 years. What's going to happen after that if you can't go back to work? So a lot of my clients have until age 65 policies where they have peace of mind knowing that they will be covered if something happens until they essentially would have retired from the workforce. But again, it's a balance between premiums, because obviously the longer the benefit period, the higher the premium. So you need to figure out the fine balance and get what suits you best.
So is this something that you need to consider with your super or out of your super?
Okay, that's another thing I talk to clients. If you're not able to get cover outside super, you certainly should get it at least within super so you have some sort of cover. But income protection, there are certain rules and regulations with superannuation that limit your ability to claim depending on the type of disability or type of claim that you're having. So if you look like you're going to be able to get back to work at some point, it might not be classified a permanent disability, and the super company might not approve your claim. So what happens is, if the super fund owns the policy, the insurance policy pays it to your super fund and they have to release it to you. So some cases they won't release it to you because it won't be classified a condition of release. Now, to alleviate that, there are new developments in the product space where some of the policies covered through super and some through your own cash flow. You can have two together and then pretty much maximize the benefits. So it's a fairly complex thing, but you shouldn't discard it completely. You should look at your options, because there is a way to get the best of both worlds. So having majority paid through super and a little bit paid outside, where you have the option and peace of mind of having complete comprehensive cover. So, but certainly if you can't afford anything outside super, make sure that you have at least something within super in case you need it.
All right. Thank you so much for sharing all those valuable information with us.
Thank you, Nishani.
Having said that, it's a wrap from this side. Until next week.